Hello, Andy, and welcome. I'm your
Yeah.
host, Charlie Mattingly, co-host Andy Christopher. Thanks for joining, Andy. We're glad to have you again today as well. We pulled you in here to talk about some exciting stuff. So you and I get to talk about some really exciting. We're going to talk SpaceX IPO, what's all the rage. But first, Andy, our mission is to deliver actionable ideas, simplify the complex, cut through financial noise, all to help build mindset for financial life success. And you've taken like a 100-page document about IPOs. You're going to simplify that. You're going to tell us what that is in about 2 minutes here. So I'd say that's going to be totally
Yeah.
worth it, right?
Totally worth it. Yeah. This is, not to foreshadow what we're going to talk about. I feel like people will kind of know. You know where the SNL skit, Debbie Downer, and it's
Yeah.
like everyone's having a good time, and then it's like,
Yeah. Party pooper.
yeah,
But yeah.
party poopers. Yeah.
Mhm.
'Cause it's a party. It's a
It is.
party for
It is a party.
SpaceX
And
IPO.
you're about to ruin
Yeah.
it, I got a feeling.
Yeah.
But it is fascinating. We'll talk about it. And again, we're going to tell the truth. The whole truth, nothing but the truth. And sometimes it's less exciting than maybe some embellishment
Yeah.
of other things. But so Andy, SpaceX is preparing for what could become the largest IPO in stock market history, targeting $1.75 trillion valuation. Trading
Mm.
is expected to start, I think, mid-June of this year,
June 12th.
2026, June 12th.
Yeah.
This is going to be unprecedented and could be one of the most valuable publicly traded companies once this happens, surpassing Tesla and right up there with Alphabet and Amazon. Andy, this seems like a no-brainer, right? Why should we not be part of this? This is history in the making. All of our hopes and dreams to become rich are
Right.
hinged on this moment.
Yeah, if you were an SpaceX investor 10 years ago, then yeah, this
Yeah,
year you'll probably be rich.
that's
You'll
a good
probably be
point.
rich
Yeah, a private when
out
it
of
was
this.
is obviously private.
Private. Yeah.
Come,
So that's, the life of a company. And I think, Charlie, like both of those things can be true, right? This can be an unprecedented, the most valuable company to ever IPO, and you can still not have great returns, right? And so it's like, and we say this all the time, maybe not in the context of an IPO, but just in the context of companies, right? There's great stock prices, there's great returns, and there's great companies. And those three things are not necessarily always the same thing
yeah,
at any one time, right? And
yeah.
so I think it's disentangling that
I got to repeat what you
concept.
said. Super important. And like you said, not just for IPOs, for any
Yeah,
stock, any company, we could absolutely know beyond the shadow of a doubt, it is an amazing company, does amazing things, makes technically speaking, a buttload of cash, but it doesn't mean your stock price is going to go up. It
yeah.
doesn't mean it's going to be a good decision to buy that because of the next thing we'll talk about in any company, especially IPOs, is that all that massive expectation is kind of priced in there. Is that fair to say?
I think that's exactly right. Yeah,
Mm.
and I think to kind of use that example, right? Like Apple, I've had an iPhone since 2007. I'll never not. Don't you put a Samsung phone in my hand? I'll just like,
Your hand
well,
melts off.
well, yeah. But that doesn't mean like Apple's always going to be a good company or a good investment. That's a future expected return type of
Yeah.
discussion. But
In
yeah,
fact, Apple, I'm sorry to interrupt you. Apple, people look back, I should have bought Apple. I should have bought Apple. I just got done watching in the airport. I was traveling this weekend, the Steve Jobs Netflix.
nice. Yeah,
But I knew this anyway. You knew this. Apple was nearly out of business. They
yeah.
were on the verge of bankruptcy at least once, and so you got to survive those in the case of Apple. But anyway, sorry, I couldn't
Yep.
resist because it's a
Yeah.
perfect example.
And maybe just take a quick step back, like what's an IPO, right? Like why do you even do it? And generally companies do it because they want to raise capital. That's the most efficient way to raise money to grow your business is via the public markets where shares trade hundreds, millions of times a day. That's how you get really good price discovery.
Mhm.
And historically, it's been more small cap companies, so smaller companies that have gone to IPOs sooner. And we've seen a more of a transition where companies are staying private longer and before they go public via an IPO. And this is sort of a manifestation of that in like a very big form of
Mhm.
SpaceX just didn't go public sooner. And so now it's a $1.75 trillion valuation at the initial
Mhm.
public offering. And so I think as an investor, you would say, well, you don't get to participate in that day one to 1.75 or whatever it was when SpaceX was created. It was probably more than $1, but not 1.75 trillion of them. So your starting point is 1.75 trillion as an investor. Whether that's good or bad, I can't tell. The market
Right.
will tell you quickly. We have history to sort of look at, and I think that as you alluded to, professor at University of Florida, Jay Ritter, he's like the IPO man,
Yeah.
and he just unloads a bunch of data. There's some really interesting factoids I think that just
Yeah.
that come out. He updates it all the time. One
Nice.
of those that struck me was average first day return of IPOs is 2001 to 2024. So pretty good time period was about 18%, right?
Yeah.
So like the very first day of
Pretty good.
trading,
Day one.
18%. So now you gotta ask yourself a question, like how do I get that, right?
Hmm.
Can I get that stock on day one? Because otherwise you don't get to participate. You get the after day one return, which is not so good.
Not
And
18%.
so yeah, not 18% there. He adjusts it for the market and some style, but essentially average 3-year return from 2001 to 2024 of IPOs has been underperforming the market by about 14 on a market adjusted basis and 13% on a style adjusted basis. So, that's after the day one. So if you don't participate on day one, your chances of you outperforming just buying an index fund are pretty low. So Charlie, I just find that's interesting. I like the numbers, the data, and it just kind of suggests that, IPOs are they're risky. There's plenty of reasons why, and it
Yeah.
may not be the best place for your dollar of an investment.
Yeah. You're just being negative, Nelly. That's all there is to it.
That's right, Debbie Downer. Yeah,
Well, it's true, and I'm joking, and it's we got to tell the truth, and it's exciting. There's a lot of hype, but let's continue this discussion right
yeah,
now for our YouTube folks because it's so hard to avoid this as an investor. I get it. People call, hey, I want to be part of this. This is historic. This is massive. A couple things. One thing I've looked at multiple times, and that's just human behavior. Like we hate to miss out. This
hmm
is a real thing that we're wired. We don't want to miss out on stuff. We don't want to miss out on opportunities. It's embarrassing. It makes me feel like I'm a loser. But also, Andy, we know that human beings seek out complexity because it makes us feel sophisticated and smart, and it
yeah,
makes us feel secure when I think, man, this is what the wealthy people do. Therefore, I should do it as well. And unfortunately, those things just kind of set us up. Andy, let's just confess right now, this thing could be a massive success. We don't know,
could be.
but
That's
if,
right.
but
Yeah.
maybe a flip of the coin might be the best way to predict anything, right?
Yeah, you're exactly right. Like I think that's a super important concept and just something to hammer down on is like when we look at the data and we say that the average return after 3 years has been negative or underperforming the market, that there's some extremes on other
Mhm.
ends that are making that
Yeah.
happen. So you're totally right. Like you could underperform or you could it could go like gangbusters and do great. You will, right, as an investor own SpaceX at some point.
Yeah.
Right? And generally, and what I mean by that is the indices, right, will start to include it. The S&P 500 typically waits 12 months before they will include IPOs into the index, and there's a bunch of other requirements it has to meet. We use a company called Dimensional Fund Advisors. They typically also wait 12 months, and there's some nuanced reasons worth getting into on why you'd want to wait that long.
Mhm.
But you'll own these companies, maybe not on day one if you really wanted to, but they'll be in your portfolio sooner rather than later.
Yeah, yeah, and it's you've made a similar point before on private equity. Yeah,
Yeah,
private equity. There's some superstars out there, and there's a lot of losers. Uh,
yeah,
but you can't go buy them all in one wrapper. So you got to make sure you select correctly. And again, we're back to the coin flip. Is probably the same with IPOs. Would you say?
I would think so, yeah. And
Yeah.
I think a couple of things is, what we shared was that day one return, I think 18%. And that sounds really great. I'm like, well, I want that. I want to be,
Hmm.
if I could just be day one and be in there. But you got to figure out how to get there. That's really challenging. And there's actually some other research and data that says that there's an allocation effect, if you will, when it comes to IPOs. If you want to participate in an IPO, and by participate, what we don't mean is after it starts trading, right? So June 12th, SpaceX will trade. You can go on Robinhood or Schwab or
Hmm.
Fidelity and go buy. We're talking about actually being allocated shares before it starts trading on the exchanges, right? So that's how you participate in that IPO. Well, there's this allocation effect, which is basically says for most investors, the stocks that have underperformed traditionally as an IPO, those are the easy ones to get. And then these oversubscribed ones that have done really well, now you've got to be in like the cool kids club to get the to get allocated. So institutional investors, endowments that have access to these, underwriters like Goldman
Hmm.
Sachs and Bank of America. So it's really hard, just to get access to an IPO, and then if it's a really, really good IPO, I'm air quoting for our
Yeah.
listeners, it's even more challenging to participate and
Yeah.
into
All
have
those
the
things you
upside.
said just make me want to be part of that IPO that much more. I really have to have it now.
Now I gotta have it.
I want to be in that cool kids club,
Yeah,
but that's the rub. That's the rub, right? It
yeah,
doesn't. It may not actually improve our economic benefit. It sure makes me feel good. Maybe my ego and whatnot. I can kind of maybe tell somebody I'm in that club or something.
and the SpaceX
Yeah,
IPO.
yeah. And yeah, and so there's a piece of me as an advisor that says, man, I wish, we could be cool and just go tell everybody that we can do this for them. And but we know that may not be best for our clients, for investors. So we got to think about this on a little deeper level
Yeah,
than just what feels good, what helps my ego. Because even the institutions you just listed, sometimes they don't do that well, and they don't do as well as an
yeah,
S&P 500 index. Sometimes there's been stories and articles and case studies on that as well.
yeah. And it's super interesting. You think about just how this IPO happens, right? And we list these underwriters, Goldman Sachs, JP Morgan Stanley. They do the road show, right? They don't know what this thing's going to trade like, and that's why you get these performance dispersions when it actually trades and the market gets a say. But they kind of just go around and get a feel for like, here's what it's valued at, and they're just selling, right? They're trying to sell
Yeah.
that stock before it trades.
Yeah. So the road show is exactly what you said from what I remember.
Yeah,
You literally go around. I think they initially throw out a number, like this is what we think the stock price will be. And they go around and they promote this company,
yep,
right? To try to maybe get more information, say, hey, we can price this higher. The interest is there. So it's really fascinating, economic
yeah,
101 kind of supply and demand, and then a guess at that initial price. And it could be
yeah.
wildly off one way or the other. Pretty fascinating.
Yeah, and you think if you're a company and you get this huge pop, then the idea is like maybe you left a little bit of money on the table, and you could because that's the chance, right, to raise the capital, right? It's
Hmm.
the underwriters, because once trades or shares are traded on the market, that's the secondary market. That's when you and I go and we buy a share of Tesla, like that's no more money going to Tesla,
Yeah.
right? That's shares between secondary participants. So it's kind of fascinating. Just that in and of itself, I think, is pretty interesting that these things just they trade and
Yeah.
they don't really impact the cash flow of the company except for the fact that they may pay some dividends or do some
Mhm.
share buybacks.
Yeah.
But it's kind of it's funky, at least if you really think about it, just what's actually happening here from a trading perspective.
Yeah. Yeah. It is fascinating. And one that we don't have to think about very often, but it's been a while since I've gone down that path. But Andy, as far as IPOs are concerned, talk to the fact that if I'm an owner, if I'm Elon Musk, and my company has gone public, I own a ton of shares because I'm an owner. What are my restrictions on
Yeah.
selling those, and how might that impact me, the retail investor that goes to buy them later, or maybe if I'm part of the IPO? What do you think?
Yeah, so it's a great point, Charlie. And what you're alluding to is called the lockup period. And so what a company and anyone wants to avoid is, because you've been private, so you've issued, there's owners, right? Whether those
Mhm.
are shares trading publicly or privately, there's owners. They own shares. It's probably in the form of stock options to incentivize your employees to work really hard and help grow this business. And so what you don't want is on day one, all of those people just dump their shares into the market and say, right, and cash out. And so typically companies will provide a lockup period of 6 to 12 months where those insiders, those company insiders cannot sell their shares. And so sort of intuitively, I think at that point you realize that in 6 to 12 months they can, and there's probably some negative pressure because of that, because now they're employees and they can finally, right after all this hard work, it was a private company, you've had this illiquid investment, now you can actually get liquidity and turn that into some real cash, real hard cash.
Yeah.
So that's an important consideration. Oh, by the way, if you're an IPO participant, you may have those same restrictions. In other words, a lot of times brokerage firms, they don't want you to do that either, right? They don't want someone who buys an IPO to also dump it. So they're not going to stop you, but they may say you're not going to be able to participate in an IPO for 12 months if you sell in the first 3 days or something.
Hmm.
So the same dynamics kind of come into play even for non-insider employee participants who are
Yeah.
just participating in the IPO.
Wow. Yeah, it's a pretty fascinating process. And can you imagine, like, hey, I'm a original shareholder when SpaceX is private, goes
Yeah,
public. My economic ship has come in. I've won the lottery, so to speak.
yeah,
But I haven't won anything until I sell those shares.
yeah,
And so
absolutely.
not Elon, he's probably doing just fine, but there'll be a
Yeah,
lot of people ready to unload those things, depending on who's the owner. I have no idea who the other owners might be besides him,
yeah, yeah,
but
absolutely.
fascinating. So and I'll tell you what, Andy, I had to go back and I'm like, what the heck is SpaceX? And so basically it's what makes it a little bit more attractive. This is going to go against our, hey, use caution kind of message, but it's basically three or four different companies, right? It's got, I think recently they bought an AI
Yeah,
company. I think X AI was purchased as part of SpaceX. They do NASA government contracting as well,
yeah,
along with Starlink is the crown
yeah,
jewel, I think I read as well.
yeah.
So that's what it is basically.
Yeah, we see the SpaceX rockets. They launch out of Vandenberg, and we've seen it,
Yeah,
up in Orange County and Newport Beach, and they just see them popping the satellites out. So
yeah.
makes me want to participate in the IPO, Charlie.
Absolutely,
I can
yeah, me
see
too.
that.
When you're
Yeah,
flying, and I know some of our pilots have seen this. I never saw it.
yeah,
You could see the satellite, I don't know, formations, above you or whatever, which is pretty incredible at night.
yeah,
So, but
yeah. It's
yeah,
impressive, no
yeah,
doubt. Yeah,
absolutely. I think that the thing that I want to reiterate is in any stock, especially in this scenario, especially with SpaceX, there's a huge hype factor. Again, this thing is already worth more or just as much as Google and Amazon. So, and oh, by the way, let me see if I can find the number. I think they lost $2 billion. The company's capital spending exceeded revenue by $2 billion last year. And so, some of those things are making money, government contracts, NASA. Some are losing massively in
hmm
the hopes that they will make money. Everybody's expecting that they will in the future because that's what you're buying, future cash flows. And if you overpay, again, this is how we started this message. You overpay for those future cash flows. You might not get a return for years, if
yeah.
if any.
If
We don't,
ever, right,
yeah, if ever.
right.
So it's not a guarantee. You're kind of buying into something early like this. You got to have a little bit of faith, cross your fingers that these things are going to come to fruition that you just bought in anticipation.
Yeah, yeah,
Mhm.
absolutely. Yeah, I think you're just right. I think the takeaway really for me is, do you want to buy individual stocks in general? And then you're probably better off just owning the market, and the data suggests that that's true. Yeah, you would
Yeah.
just be better off just in a buy and hold strategy of a market like portfolio than trying to chase these returns with IPOs and
Yeah.
the hot stock.
It sure is boring, but like you said,
Yeah,
the numbers are pretty powerful. as
Yeah.
far as the story that they tell and those 100 pages of documents you read from the University of Florida IPO expert. But
Yep.
well,
Yeah.
Andy,
Fascinating.
yeah, thanks for the time today. If anyone has any questions about IPOs, investing in general, we're part of Leading Edge Financial Planning. We started off with our podcast message here at the beginning of this video, but give us a shout. Email Andrew you can email me, Charlie, at leadingedgeplanning.com. Make a comment in the YouTube section here, and we will try to get around to responding those as well. But thanks for listening. Share the podcast, share the YouTube video, and we'd love to hear your responses. Thanks, Andy.
All right. Yeah. Thank you.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.